What's going on, fellow crypto heads? Mark Fleetwood here. Welcome back to the Daily Grind Trader. Today's video is to give you 3 tips to maximize profits with margin trading. Guys, I'm not a financial advisor and this is not financial advice, but I've done this. I've been margin trading for a while now. I've had the highs, I've had the lows, I've been liquidated, I've made the mistakes. So without giving you financial advice, I can at least tell you what I do, the rules that I follow to make sure that I am successful in margin trading. So we're going to hop into a chart just so that we have something to visualize with it. But we're going to look at Solana because that's a position I've entered recently. And the first tip is to make sure, and it's going to sound really simple, but you'd be surprised at how many people don't do this right off the bat, and they don't figure it out until they're kind of already either in the hole or not in a very strong position, is to understand your trading time frame and your goals. Are you trading on the daily chart looking for swings? Are you looking to be in a position for 3 weeks and catch a swing low to a swing high? Are you scalping on the hourly chart or even the half-hour chart, making 2 to 3% moves and getting in and out at small profits and doing 2 to 3 trades a day? Or are you looking for breakouts and only trading breakouts and retest and hoping for a 6 to 10% swing where you might get 1, 2, 3 breakouts a week maybe? Breakouts, you have to stop loss. You have to make sure you have a good stop loss because a fake break can come back and dip all the way through the whole pattern that you were drawing and invalidate the whole thing. So there are different rules for different types of trading, and you have to know what it is that you plan to do. You have to know what the rules are for your style of trading and what you plan to do. The rest of the tips are going to be for swing trading, for longer term holds, because I think that's what people tend to have the most problem with, and what people get stuck with the most is when they get into a longer position and they don't take the proper precautions. Knowing the length of time you plan to be in a position also determines how heavy you can go in your leverage, how high of a debt ratio you can go. You can go up to 75–80% if you're looking for a quick scalp and you're watching on your phone or on your computer the whole time the trade is happening, and you can get in and out at the moment something you don't like happens or the moment something you do like happens, and you're watching the position. You don't want to have that same level of debt if you're in a long-term position where you're going to have to sleep on it. You're going to have to go to bed and hope that there's not a market crash in the middle of the night. You have to make sure that you are aware of your position and the rules that are associated with it. Rule 2 is that you can never lose track of your investments. You can never lose track on margin because it is too easy to get punished. This has happened to me where I bought a position, immediately got some gains, and never set a stop loss. And I'm up 8%, 10%, 12%, looking good. I haven't decided to sell yet, and I go to bed on that 4th day, and the whole market drops 15%. You know, Bitcoin has a tumble, all the alts follow. Damn, I'm 40% in the hole. I was up 120%. Now I'm 40% in the hole because my 12% gain came down to a 4% loss. And on 10x margin, everything's amplified. Your gains and your losses are amplified. So you can never lose track of your investments, and you can never go to sleep or go to work or go to school without having a stop loss or a profit stop drawn. Put it in play. And remember this, because you would be surprised at how many people don't know this. A stop limit order does not pull your asset. The stop has to be hit first, and once the stop is hit, then the limit order pulls your asset to be sold. A limit order pulls immediately. So if you have a target price that you want to hit and you put a limit order for that target price, and you put a stop limit for a stop loss or a profit stop, you can't have both set at the same time, because the limit order has already pulled your funds. So then your profit stop or your stop loss will get canceled because the stop will hit, but your funds aren't there. So then the limit order gets canceled. So you will lose your profit stop or your stop loss if you have a limit order set. So remember that a limit order will stop a stop limit order from filling. Keep that in mind. So we're going to look here at Solano, and I'll show you guys where I entered, or Solana. Show you where I entered the trade, my initial stop loss, and then how I have bumped up my profit stops from there. Here I entered at $186.80. This is my entry point. My stop loss was the bottom of the wick. This was Sunday. This was a deep dive before everything to start to pump up before the end of the week. So I saw this wick and I saw it starting to buy back up, and I thought this could very easily be it. This could be the reversal. We hit the long-term support, the trend line support. So I bought as the price action started to buy back above it. I knew if it went back below this wick, it wasn't the move I thought it was. Sell here, take a small loss, and I am back to the drawing board. So this was my initial stop loss. It bought up, closed the day at over $200. The second day started to pump up, so I changed my stop loss to a profit stop to say $190. This will be an 18% gain, 1.8% and 18% on margin. So worst case scenario is I gain 18%. Today, once this pump started to happen, I changed it to $200. This is now my current profit stop. So my current worst case scenario is that I make 70% off of this trade. Worst case scenario, 70%. And once I know we are completely clear of this 382 line, I will change my profit stop up to 204.77. And this would be my profit stop here. If you're going to be in long-term positions, you have to be diligent in never losing track of your investments and never having yourself be in a potential to lose everything because you held a little bit too long. That is the worst case scenario on margin, is to hold a little bit too long or not see a dip coming, or to be money-ized because you're up 180% or 200% or 300% on margin on a long-term move, and you don't realize that the bottom falls out and you lose much more than you realize for every percent that you lose. With this being said, with setting profit stops, you can use so many different tools. You can use moving averages, you can use Fibonacci lines, you can use previous support resistance lines. Go just slightly below it, hope that a wick doesn't catch you, but know that even if it does, if you believe that the move is still going, you can buy back in. But you can take your, at this point, 70% profit and be okay. I'm okay if this happens. If this breaks here and stops, I'm going to play the breakout of this wedge. I'm going to turn this into a breakout trade. I'm going to trade this breakout and see where it goes. That would be my next entry if I get stop lost. The third and probably most important tip here is going to be margin weaving. And I don't know if this is a term that anyone else uses. It's something that I just started thinking about because of having an ability to weave yourself in and out of different debt ratio ranges to stay profitable and to get yourself into multiple positions. So guys, I'm going to link the video to how to become liquidation proof to show how liquidation levels are calculated, how margin is calculated. But essentially, if you have $500 in a margin account and your first trade is with 25% of that account, you will have $1,250 into an asset at 60% debt ratio. Now that asset gains 10% of value, and that will bring your debt ratio from 60% down to 54%, 54.5. You can enter another trade at 25% of your remaining amount. Whenever you trade on KuCoin, and I'm using this as my point of reference because it's what I trade on, you have the option of 25, 50, 75, or 100%. 25 is the only option there that I use. A lot of times I'll make multiple trades at 10 or 12%, and I'll manually enter a 10% trade, manually enter a 10% trade, and I'll have 3 positions or 2 positions to equal that 25%. But regardless, if you're in a 25% trade, and that trade has a 10% growth, you can enter another 25% trade because the 25% will always be 25% of your remaining loan value, not your total, your remaining value that is not currently indebted or that is not currently being used. So what that will do is that will give you a second trade of roughly $937 that you can put into a secondary asset, and it will put your debt ratio at about 73%. What that does with a profit stop and a proper stop loss and a proper profit stop, neither one of those positions can lose enough to liquidate you. Neither one of those positions can lose enough to put you negative in overall profit or get you out of profit. Neither one of those positions can cause a problem big enough to where with a good stop loss and a good profit stop, it can't put you in a bad spot. So this will weave you between 55 to 75% debt ratio at all times, so that as the values of your assets grow, you can add additional assets from 60% down to 54%, up to 75%. Now you got two assets that can potentially gain 10% again and drop you back down to 60. And then you can take another 25% of your remaining value, and that'll put you back up to 75. And as they grow, you can weave a second, a third, a fourth asset into your margin account while keeping your ratio relatively low and keeping profit stops, so that if there is a dip, you're out, you don't lose money, you're in profit, you stay profitable, and you never worry about that dip being the one that gets you. That dip will not be the one that either makes you A, break even or lose money, or B, liquidate you. So with that being said, guys, those are my three biggest tips to be the most profitable possible on margin trading. Thanks for watching, guys. I hope you enjoyed. And as always, until next time, peace.